This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
Sir Isaac Newton was one of the greatest minds of his generation, yet not even he was able to successfully time the stock market. Newton was an early investor in the South Sea Company, which was founded in 1711. After he made a healthy profit investing in the company, Newton sold his shares because he thought the investment would eventually end badly. After he sold, however, the price of the South Sea Company continued to climb. Unable to bear watching others get rich while he sat on the sidelines, Newton eventually caved and bought back into the shares. In 1720, however, the stock collapsed. After the dust settled, one of the greatest scientists of his generation had lost the equivalent of millions of dollars in the South Sea Company. Newton was able to predict eclipses to the minute, yet he was not able to predict the financial markets nor control his own emotions. Trying to time the stock market is as old as investing itself. The appeal is obvious. If you're able to sell when the market's at its high and buy in when it's at its low, you can increase your returns substantially while eliminating or greatly reducing your downside risk. In theory, market timing is the perfect investment strategy. In practice, however, it is virtually impossible to achieve consistently over time. Most who try it, and most of us have tried it, end up worse off than had they just remained invested the entire time. Here are the top 7 reasons why trying to time the market is a bad idea. The first reason is you must be right. One of the most common catalysts for investors trying to time the market is by following the investment news cycle. Every day, investors are bombarded with headlines forecasting the next bear market or economic recession. If the so-called experts are predicting a recession or a market crash, shouldn't you take action? Unfortunately, investing based on news headlines or expert predictions is usually a recipe for disaster. Time and time again, predictions from experts have failed to materialize. In 2011, the U.S. credit rating was downgraded, and Europe was in a debt crisis, so many commentators warned of a so-called double-dip recession following the 2008 and 9 financial crisis. That never happened, and stocks rose in 2012. Again, in 2015 and 16, predictions that falling oil prices would lead to a recession also failed to materialize. Experts predicted that Trump's election victory in 2016 would lead to a market crash. Stocks actually hit new all-time highs in 2017, which was one of the least volatile years on record. Trade war fears in 2018 failed to materialize. Stocks also finished the year higher. The yield curve inverted in 2019, which up until that point had been a surefire predictor of a recession, which of course did not happen. The recession that did happen in 2020 was not because the yield curve inverted, but because of the pandemic, which of course no one was able to predict successfully. In 2022, as the U.S. Federal Reserve raised interest rates to fight inflation, most economists were forecasting a recession. In October of 2022, Bloomberg economics modelers said there was a 100% of recession over the next 12 months. There was no recession in 2023. Unemployment stayed low, the interest rates started to fall, inflation came down, and the U.S. stock market again hit a new all-time high by the end of the year. In July of 2024, BCA Research predicted the U.S. would fall into a recession by late 2024, and that the stock market would plunge 32% in 2025. Meanwhile, the S&P 500 continued to surge, reaching an all-time high of over 6,000 points to end 2024. And as we know from earlier this year, Trump's trade wars threatened to plunge the U.S. economy again into a predicted recession that, as at least so far, failed to materialize. Despite the S&P 500 having quite a bit of volatility to start the year, again, stocks have now reached a new all-time high. So being right about the economy or stock markets is notoriously difficult, but that's not the only reason you should avoid market timing. The second reason is that you have to not just be right once, but twice. To be a successful market timer, you not only have to predict when to sell, but also when to buy back in. Even if you were to correctly predict a market downturn and successfully move to cash at a good time, you then face the equally hard task of determining when you should buy back in. And the perfect time to buy is almost always when things look their absolute worst. Markets often turn when pessimism is at its highest, which means those who were successful in a well-timed exit may find it difficult to get back in before the market rebounds and they're forced to buy at even higher prices than they sold. Reason number 3, the best days come in the worst of times. Speaking of rebounds, 78% of the stock market's best days have actually occurred during bear markets. And you don't want to miss any of the market's best days. If you do, it will significantly hurt your long-term returns. Ned Davis Research looked at the S&P 500 returns from 1995 to 2024. An investor who missed just the 10 best days out of those 30 years would have had their overall returns cut in half. And missing the 30 best days reduced overall returns by an astonishing 83%. To put that into context, there were roughly 7,500 trading days from 1995 through 2024. So just 30 of those days, or 0.4, wiped out almost your entire gain for that period. Time in the market is critical because missing even just a few good days can lead to dramatically worse investment results for you and your family. Reason number 4, there is no evidence of a single successful market timer. To date, we have not heard of a single successful market timer, and we're not alone in that. Many famous investors, from Warren Buffett to Charlie Munger to Jack Bogle, have echoed the same sentiment. Investing legend Jack Bogle, who was the founder of Vanguard, said that in his 50 years in the investment business, "I don't know anyone who has timed the market successfully and consistently. I don't even know anybody that knows anybody who has." So while we may not know anyone who has successfully timed the market, we know a lot of people who have unsuccessfully timed the market, and that brings us to reason number 5. There are plenty of examples of unsuccessful market timers. Decades ago, Mark Holbert tracked the investment performance of dozens of investment newsletters. Many of those had engaged in active market timing. His results were pretty sobering. In the decade ending 1997, not even one of the 25 market timing newsletters had successfully timed the market to the extent that their long-term returns were better than a simple buy and hold strategy. The average return of the market timer was 11.1% per year, while the S&P 500 returned 18.1% a year over that same time period. Newsletters are one thing, but what about professional money managers? John Hussman was a PhD economist and became famous for his bear market calls. His Hussman Strategic Growth Fund made stellar gains during the stock market's 2000, 2001, and 2002 dot-com collapse. He repeated his success in 2008 and 9 when his fund lost just 9% compared with 37% for the S&P 500. However, Hussman remained overly defensive in the long bull market that followed. By early 2014, the 5-year returns of Hussman's fund were minus 3.5 compared with 22.2% for the S&P 500 index. The siren song of market timing affects millions of investors. Morningstar's annual Mind the Gap survey found that over the 10 years ending 2023, the average mutual fund in their universe returned 7.4% per year. However, the average investor in those funds returned just 6.3% per year. That 1.1% gap was attributed largely to investors' efforts to market time, buying funds when they were at their highs and selling them when they were near their lows. The evidence is simply overwhelming. Sir Isaac Newton couldn't time the market. Market newsletters haven't been able to time the market. PhD economists have not been able to time the market. And millions of investors studied by Morningstar has also failed to outperform the market. Many of the world's greatest investors don't even attempt it, and we will be wise to follow their lead. Reason number 6, transaction costs. There is one more reason to consider why timing the market is a bad idea, and that is transaction costs. If you sell a stock or a fund at a gain, you're going to have to pay the IRS some capital gains taxes. So anytime you sell out of a fund and pay gains tax, you're reducing your long-term returns by reducing the amount of money that's in your portfolio and able to compound. Even if you try to market time in a non-taxable account, there are transaction costs associated with buying or selling funds or stocks. Studies have repeatedly shown that even market timing systems that appear to work in hindsight have actually failed to outperform once you consider these transaction costs. By contrast, a patient buy and hold investor eliminates these transaction costs and defers taxes as long as possible, which makes the difference between a buy and hold investor and an attempted market timer even wider. Said another way, not only does your market timing system need to work better than a buy and hold strategy, but it has to work better plus enough to cover the costs associated with your transactions. And finally, reason number 7, there's a better alternative. Anytime you feel anxiety from a scary headline or economic prediction, try to remember the many false alarms of the past. There are always things to worry about when it comes to investing in stocks. Sometimes those worries do come to fruition, or sometimes even worse than originally feared. In the history of the US stock market, we've had 2 world wars, threats of nuclear attack, the Vietnam War, wage controls, price controls, high taxes, low taxes, 2 oil shocks, a one-day drop in the Dow of 508 points, a global pandemic, communism, socialism, Democrats, Republicans, assassination attempts, assassination successes, bad managers, inefficient governments, deficits, huge government debt, protests, recession, housing collapses, credit crises, and more. Yet despite all the terrible things that have happened over the last 200 plus years, the stock market has been the single greatest wealth building machine in human history. So resist the odds to time the market. Instead, base your strategy on long-term principles. Buy high-quality assets, diversify your portfolio, and stay invested through thick and thin. The more time you own a portion of high-quality companies, the more your odds of success will go up.